Welcome to Top M&A Entrepreneurs. Today, my guest, and having back for a second time, Sean Smith from Search Fund Investors and founder of SMB Investor Network. Welcome to the show, Sean.
Thanks for having me again, John.
I got to tell you, so first of all, we're going to talk about SMB Investor Network and why you built it, what was the need. But I got to tell you, I am not an equity partner, full disclosure, not an equity partner, but I am an advisor. I value the service because, let me describe the scenario. I help people, teach people how to buy their first business. And so more than common, I come up with some individual that's a W-2 or military guy, and they got a great credit score. They find a business. They can get an SBA loan, but they need 10% down equity injection. So they don't have $300,000 to put in there. So what do? And that's where I think you guys come in, SMB Investor Network. So tell me a little bit about the business and why you built it.
Yeah, absolutely. And as you said, we spoke probably 6 or 9 months ago or so about Search Fund Ventures, which was our fund, right? And that fund is still humming. It's got committed capital, and we invest in exactly the kind of folks that you just talked about, right? But what we kept seeing was there's an opportunity to bring more investors into these deals, in many cases beyond what our fund invests. And that's a really big way to support folks like the person you described who needs that extra capital to buy their business. So if we can't get the full amount through our fund, in many cases you can't, because with SBA deals, you can't own more than 20%, right? We can send that around to our network and bring in more investors to be supportive there. So that's really the goal, and that's why we've started it.
So you have another partner, Nick Bryant, and he's more the coding guy, and he's also a Silicon Valley guy. When the first time we talked, he said, this is like Angel List. And if you've ever been in Silicon Valley, you know what Angel List. It started 15 years ago or so, just a list, an email list of people said, hey, if you know of some deals, let me know. I'd be interested in investing. So you guys kind of built this on that model, right?
That's exactly right. And it started the same way. We had an email list. We still have the email list. And essentially what we would do is send around co-invest opportunities that we had looked at for the fund. We'd said, this is a great deal. We want to invest in this. And then we would send that around as a newsletter, basically. Say, hey, here's a deal that Search Fund Ventures is investing in. Come join us. And like you said, Nick, my business partner, saw that and said, hey, there's a real opportunity. We've already got this great network. We grew it to about 250 people in less than a month. And it's now at about 1,200 folks over the course of, 6 months of kind of sending around deals. And Nick said, hey, we've got the network. It makes all the sense in the world to turn this into a platform, right?
Yeah. And Nick's a magic coder, man. He turned that thing around pretty fast.
Unbelievable. That's for sure.
Yeah. So let's talk a little bit about what this looks like. So when it comes to raising equity injection for an SMB acquisition, where do most first-time buyers go wrong when they do this?
Yeah. So I think one of the trickiest parts about raising equity in this, self-funded search, independent sponsor world is you have such a narrow time window to do it, right?
What is that? That's like 90 days, right?
Yeah. I mean, it kind of depends on the LOI, but more than that, it depends on when you get your marketing materials together to actually go hit the market, if you have to go to the market, right? So, what a lot of folks do, you spend 12 months or more searching to find a business. You finally have got the great business that you're excited about under LOI. Your LOI has exclusivity for 60 days. Now you've got to scramble to get your materials together to go send that around to investors and to go start having those conversations, right? So we like to try and, start speaking with searchers, independent sponsors, folks that are kind of, I would say, newer to the small business acquisition space. We like to speak to them early so we can kind of set that expectation that once you start going to the equity markets to raise capital, most investors are going to need at least, 2 to 4 weeks to make their decision in a lot of cases, right?
Just
so
think on it, do their due diligence, right?
Exactly, right? So you're going to, if you don't start marketing that deal until 30 days into your exclusivity period, you're cutting it really close. Right. So we recommend to folks they start talking and getting their stuff together, at least building the relationships, right before they sign that LOI.
Yeah. So what I see frequently is, the buyers, they'll go out to biz buy sell, they'll find a good business, just an example, and they'll put an LOI on it. And they're eligible for SBA because they say the BDO from SBA says, pre-qualified, right? I'll get that. But they don't know where to go right now. Most people don't know where to go to raise $10,000, let alone, 200.
Yeah. Well, so that's what we are certainly trying to, establish is that we've got a great network of investors. Folks can come, in some cases we can be between our fund, between the network and some of the lead investors we work with, we can be the sole kind of source of capital if they need that. And at the very least, we can really be a supportive partner in getting that equity raise to the finish line. So that's exactly why we're building what we're building.
All right. So what type of deals attract investors the most that you think if I go to SMB Investor, I start filling it out, which ones attract the easiest right now? Which ones like, oh, that's going to be hard to do to fill out?
Yeah. So I'd say, the general search fund or small business acquisition thesis is still kind of the one that most of our investors are anchored towards. And what that looks like is, a healthy, essential business that's been in operation for probably 10, 20 plus years. The owner is selling it because they're ready to retire. There's probably a meaningful portion of consideration that's deferred in either a forgivable seller note or something similar to kind of align those interests and reduce the multiple. And ultimately, you're buying it, below 5 times EBITDA. Those kind of low purchase multiples are one of the reasons so many people, all the investors we talk with say, we're so excited about this space because you can purchase great businesses for so much lower than you can in the public markets, for example. So I think those dynamics are critical. A lot of folks focus on revenue quality and kind of those essential industry dynamics, like I talked about. So are there recurring contracts that, create those kind of recurring revenue streams or reoccurring purchase behaviors? Is the industry itself generally, non-cyclical, non-sensitive to discretionary spending? Those sorts of dynamics are, the ones that all culminate into a really attractive profile.
Yeah.
Go ahead.
Let me go through a couple examples. What about e-commerce right now? I know right now we're in the middle of a tariff war with China, and anything come from China has got 100% plus import tax on it, basically. So, what about e-com? If it's not Chinese good, what about e-commerce?
So, when you think about e-commerce, you got to think a little bit about the product, or if someone's selling a service through like a service marketplace, if you're considering that e-commerce, you got to think about what is the actual product or service being sold through an e-commerce platform, right? And I think again, you want to look back to that essential kind of almost mission critical type dynamic for a lot of these types of deals. That's not to say all investors think that way, right? I think that's kind of one of the more common themes in the space. That's how we, from the fund, typically underwrite deals. But there are some folks that will say, as long as the company has demonstrated a great kind of consistent earnings profile, that's just as good in our mind as it being kind of mission critical. And I can give a great example of that. There was a really interesting business with a great sponsor backing it in the eyewear sector, and the business had just had tremendously consistent earnings over the past 10 years. Not even a single blip, not during COVID, not during any kind of shocks you might expect. But we deemed that the business itself was not essential, right, to the buyers. It wasn't kind of glasses or kind of prescription lenses. It was more towards kind of the sunglasses and that kind of angle. So it wasn't a fit for our fund. But there's plenty of investors that could have been all over that deal and that it could have made a lot of sense. So I think if you think about
SMB Investor Network, right?
Certainly. Yeah. So I think if you think about, something like e-commerce, you're going to want to look closely at how much of the, how consistent is earnings? Are there, reoccurring purchase dynamics, just all the indicators of high quality revenue?
Is it a good deal? It's always back to, is it a good deal, right?
Right. Exactly.
Yeah. What about, let me ask you about med spas and software. So you can talk about those.
Yeah. So med spas is an interesting one. We know a few folks that have done tremendously well in that space. I think, again, the med spa deals we've looked at have not kind of passed the essential business test for us. But they certainly pass high quality revenue dynamics, right? And that's part of the reason people have done so well in that segment. If you have, a treatment that once you start doing it, maybe it's Botox or something similar, you need to, kind of keep going back.
Injectables, man, you get addicted to it. Not me, just saying. I looked at it at med spas. It's the addiction to injectables.
I teed you up for that one, to be fair. But yes, the kind of recurring dynamics in that industry are certainly there, right? Software, that one really just depends on the essential kind of mission critical piece, and is it something that once someone purchases the software, it becomes essential to what they're doing, whether that's their lifestyle as a consumer or if it's a business. I mean, think like a CRM. Once you start using a CRM, all your data is in that software. You start building processes around that software, it becomes pretty
Switching
essential.
costs are too prohibitive. Yeah.
Right. So the same dynamics exist. The one thing about software that's been challenging from a small business standpoint is it has kind of global, economies of scale in a sense, right? So you can really run a software company from anywhere and essentially have competitors that are running software from anywhere. Versus if you think about like a trade contractor, an HVAC business, you got to have folks within a 50-mile radius pretty much of that, service area, right? So that is one dynamic that makes competition a little more challenging in software.
Yeah. What about accounting firms?
We've looked at a couple accounting deals, and I think the essential dynamics are certainly there in certain categories like tax and like bookkeeping, things like that. One of the challenges with accounting firms, depending on the size, and this is true kind of for any professional services firms, a lot of those relationships tend to be with the owner of the business, right?
Yeah.
In many cases. So you can almost expect when you buy, a business like that, a professional services firm, that there's going to be pretty material churn in the early days, first probably 12 to 24 months. So you almost have to underwrite the deal, assuming that you're going to lose customers who were golf buddies, right? Now the challenge is figuring out who or which customers are, have those dynamics. But
yeah, I'll tell you a story about that. I did some work for a guy that owns a very large accounting firm in Las Vegas, and somebody brought me a deal. It was in Northern California. The guy was 78 years old, and he had these questions all teed up. He goes like, "Hey, how did you bring your business in?" Oh, Rotary Club, Kiwanis Club, meeting people in Chamber of Commerce, stuff like that. And he like put a risk on that of how many people he'd lose after he bought it. He thought, I think it's 50% of clients will lose. He said he's not going to buy it just because they were too attached to the owner.
Yeah. I mean, look, if you can underwrite a deal with that assumption in place, I mean,
price that into it. Yes,
exactly. Right.
Yeah.
I mean, that's the quote from, I think it was Warren Buffett or someone similar that said, the best diligence is buying at a low price. Right.
Yeah.
So,
yeah, those risk ins. So which are the hardest to fund? I'm not only talking about, search fund ventures, but right now, SMB Investor Network has 1,200. A year from now, it could have 10,000 people. So there could be an Airbnb variety going on in there.
Yeah, that's absolutely right. I mean, I think the market right now is most, favorable to businesses that generate a nice amount of cash flow that's pretty durable and, visibility into that cash flow, those earnings is pretty certain, whether that's through backlog or contracts, multi-year contracts, things like that. I think that's what right now, that's where the market is most excited, or most favorable towards. I think towards the kind of growth strategies, especially those that aren't necessarily very profitable at this point, and there's some uncertainty around, where they're headed. Those are the ones that are most challenging to fund right now. And you see that, in many areas of the venture capital market too, right? Other than AI, a lot of funding is dried up for companies that are not generating a profit and need capital to grow. So.
Yeah. All right. So how much personal capital do buyers, let's say somebody, SMB buyer comes in, great credit score, got the deal under LOI, reasonable valuation. How much capital should they bring in to the deal, their skin in the game? Because this is essentially supposed to say, okay, we can make up the difference, or we can bring much more than the difference. What does that look like?
Yeah, it varies a bit. There's kind of this concept of the self-funded search structure and then the independent sponsor structure. But generally across the board, if you're talking about deals that are below 3 million in EBITDA earnings, right? You're not talking about kind of the lower middle market private equity deals that are, 5 million in EBITDA or something like that. These these kind of micro cap deals, as they call it, you generally see around 2 to 5%, depending on the deal size and kind of the searcher or sponsor's background. 2 to 5% of total sources of capital comes from that searcher or that sponsor.
2 to 5%. Okay.
It's not uncommon.
Of the total enterprise value.
That's right. Yeah.
Yeah.
It's not uncommon, to see, call it 200, 250K or so from a single searcher or even a partner search team invested in the deal. We've seen as low as, 50K on smaller deals. But usually there's something there, right?
Yeah. Is this kind of clickbait-ish question? What about somebody that says like, man, I don't have a lot saved, or something happened in their past, they don't have a lot saved, kind of going, can I buy this business with basically no money out of my pocket? If I go to search, SMB Investor Network, and it's a great deal, and I could, 10,000 people in the list a year from now, maybe they say they'll put up a couple $100,000 for X percentage of the company. Possible?
Yeah, we see deals marketed that way plenty, right? And we have not invested in a deal where the searcher or the sponsor has not put any money up to date, but we know it gets done. I would say part of the consideration there, if folks wanted to go that route, would certainly be, aligning your track record or your background with the business you're going to buy, right? Making sure it's a good fit for your skill set. And also, offering good terms to investors, right? That can be another way to kind of clear that hurdle. You may see a lot of folks who put in more capital into the deal, will kind of bring terms for investors down to the lower end of the spectrum. So there's obviously, there's levers you can play with here if you want to commit less capital to your own deal, for example.
So you brought up a point. What are investors looking for in the sponsor, the operator? What kind of track record is this? I mean, it's easy to say, well, you've been a W-2 in a clerical office. I don't recommend you buying a trucking company.
Yeah. We touched on this a bit in our kind of earlier show, but the kind of two schools of thought that I think continue to emerge are, on the one hand, you've got sort of a searcher or a sponsor that's got great business acumen, maybe more of a generalist skill set coming out of a private equity or consulting type background, but no kind of, specific leadership experience in a single industry, right? More of that generalist and business acumen approach. For those
transferable skills, we'll call it. It's like,
right. Yeah, that's a good way to put it. Those kind of folks, I would say the prevailing path to raise capital from investors is to find a business that is generally, fairly easy to run, not high inventory levels, not a tremendous amount of CapEx, more of a kind of services, straightforward business model, right?
Not a like buying a software company requires a lot of coding continually. Yeah.
Yeah, something like that, right? The R&D expenses, however you want to chalk up CapEx, something similar. The other kind of school of thought is, let's find an operator, or the operator, finds a business themselves, and they have, a really strong track record in a single industry, right? They're very strong in, you said trucking. Say they're very strong in logistics. They've got a great background, maybe even owned a business in the space before, or were a general manager at a private equity backed company. They know the industry, they've got contacts, they know the business model and operations inside and out. For those folks, you can acquire a much more complex business in that industry, and you can get comfortable with that because they have a track record in that space. So I think it's really important to kind of think in some of those frameworks, right? If you don't have a really strong background in an industry where, there's more complex dynamics, you probably shouldn't be searching for a business in that industry. You should probably focus on, business models that are a bit easier, right?
Yeah, easier to understand. That brings me to a question. A lot of information floating around at X and LinkedIn. What are some common myths about raising equity for SMBs that you keep running into?
Yeah, it's a great question. I would say, I don't know whether this is a common myth or not, but I do think there's, sort of this concept of investors are looking for a 1.5 times to 2 times step up on their equity. And I actually, have spoken a good bit about this, but I do think there's, probably schools of thought on this as well. But there's folks that are focused on getting, a step up, and there's folks that are more focused on kind of the holistic deal structure. And I'd say we're very much in the latter camp, right? I'll give you an example. If you have a deal that has taking 90% SBA loan to finance the deal, and they're raising 10% of the capital from equity investors, and you offer that person a 2 times step up, they walk away with 20% ownership. They gave 10% of the sources of capital. You give them a 2 times step up, they've got 20% ownership.
And that's usually not at 10 years. It's usually at 5 years or
right,
whatever
yeah,
the term is. Yeah.
Right. It's just the step up on their basis invested into the enterprise value. And the challenge there is now you've got, if that business was bought at, 4 or 5 times, you could have a pretty substantial amount of kind of financial leverage, debt to EBITDA on that business. You may have pretty, thin debt service coverage ratios and just a generally risky credit profile for the business. And investors only own 20% of that business. So there's just an asymmetric risk reward profile there, not in a good way, right? You're taking a lot more financial risk than you're actually getting compensated for on the deal structure. So that's kind of one. I don't know if I'd call it a common myth, but I think it's one thing that, people should pay a little more attention to when they're putting these deals together, right?
Yeah. It goes back to that debt service coverage ratio, and private equity likes the 2 or higher, but these BDOs from SMB, they'll go, oh, it's okay with the 1.25.
Yep.
That's scary.
Yeah, it can be. And, we kind of our low end is in that range. So we can get comfortable with pretty low debt service coverage ratios. But frankly, the deals that have passed sort of our margin of safety tests, right? We really want to see a good margin of safety in the deals we do. They're usually up towards that 2 times debt service coverage, if not even.
Yeah, there's got to be a room for everyone. Somebody goes like, you're buying a business and the previous owner was only taking a 75,000 salary, but the area that they live in usually requires 150, and they go, well, we got to add that in too, right?
Yep.
Changes everything.
Well, and that's why you can never rely on SDE for these, right? You got to really calculate the actual, earnings to investors, or ideally you go all the way down to the free cash flow, figure to investors.
Yeah, I got to tell you, we're looking at one of my students looking at a deal right now. So the sim says one thing, the QuickBooks file says another, the tax return says another, and then we go, okay, they're all contradicting each other. This is not where we go. Send me the bank statements for the last 12 months. So the bank statements actually show it's making a hell of a lot more money than all three of those show. Because there's just the individuals using it as a personal bank account, which is not illegal.
Yeah, and that's kind of underpins the importance of a quality of earnings report, right?
Yeah.
And one of our criteria, right? We need to see a third party kind of quality of earnings done because, to your point, so many business owners use that bank account for things that aren't necessarily business expenses potentially.
So would it, before you put a deal on SMB Investor Network, would you require a quality earnings? Or a light one at least? Yeah.
Yeah. So we want to see before we, commit, we want to see that the quality of earnings verifies all of the kind of assumptions we may have been making. Generally speaking, anything I guess to date, deals that we've put on SMB Investor Network have already had a quality of earnings done. But the way we run our diligence process would be, to conduct diligence on the information we have. And then as new information comes in, for example, a roll forward of a Q of E or a fresh Q of E, we would then go back and check to make sure our assumptions are still valid based on this new information.
Yeah. All right. Let me ask you another question. How should a buyer structure the terms of the equity raise to make it attractive and fair for all parties? And you talked about the step up. We get that, but what does that look like? I mean, the assumption I'm working on is like, hey, they're looking for some type of multiple on invested capital. They're looking for some number, IRR. What's fair to them? Like attractive to somebody on SMB Investor Network?
Yeah. So I think, there's a couple good assumptions you can probably make when putting together terms for investors. The first one is that whatever financial projections you're putting together, investors are going to be more conservative than you. So if your financial metrics,
don't use the word conservative.
That probably doesn't need to be, said. But my point is that, if you're assuming that you get to your 30% IRR and you're growing at 15 to 20% per year in your projections, so you create investor terms based on that projection, you can almost be certain that investors are going to be assuming that you're going to grow the business at 3 to 4% per year. So what do the
math doesn't math?
Right, exactly. So what do the terms need to look like in order to foot with those more conservative assumptions, right? And I would say the same goes for, EBITDA margin assumptions. If you assume you're going to be able to introduce cost efficiencies that create 5% more margin, we have, in certain cases, we've gotten comfortable with, assumptions like that, as long as there's really detailed, almost like line item level planning behind it. And again, going back to kind of the track record discussion, if you can say, I was at McKinsey, I've been integrating M&A deals for the past 20 years. We know exactly how to run this playbook, and I've done it in this industry 100 times. Sure, right? We can probably give you more credit for identifying, those operational efficiencies. But if you're kind of on the other end of the spectrum where you maybe haven't done that so much, you're a newer acquirer, it's going to be a lot harder to give credit for assumptions around operational efficiencies. So that's kind of the first.
So what about that's okay? That's like I'm going into an SMB and say I'm going to drop G&A 10%. Okay, great. I understand it. You've done it before. You do it again. That's what PE does, right? It goes in there. Operational efficiencies. But if somebody goes, I'm going to grow it 30%, you're definitely going to be skeptical about that one.
Well, I think we're going to be skeptical in general on both sides. Any, substantial assumptions that are impacting cash flow, we're going to be, it's going to be, skeptical until we have kind of enough information to really prove that there's a clear path to getting there. So sure, if I think on the growth side, the same concept applies. If you said we're going to grow revenue by 30% in year one, here's a list of, industry contacts I have personally worked with historically who we've already started talking to and who've said they would love to start using our, whatever
they're going to buy, industry. Right?
Yeah. Right. So it goes both ways, but it does really, go back to that track record versus no track record, but a more simple business question, I think.
Yeah. So what are some of the big red flags investors watch for when evaluating a deal? Putting up, you're not going to just put any deal up on Investor Network. There's going to be somewhere like, no, that's a red flag. That's going to keep you from getting uploaded.
Yeah, and we've certainly been, pretty, we've got pretty tight underwriting criteria that we use to date. I would say, it varies for each investor, but there's kind of three recurring risks that we see almost in every deal we do, right? So the first is customer concentration, generally in kind of B2B industries or B2G industries, right? You don't see that as much in B2C. If you do, something weird's going on. But in kind of, most B2B, B2G industries, especially in like manufacturing, for example, the companies tend to grow with, a single customer, right? Or a few
like
customers.
General Motors or something like one.
Right.
Yeah.
They've got a great contract or they've got great, recurring purchases from that customer. So they continue selling and upselling into that one customer. And all of a sudden, you've got 40% customer concentration or something like that. So that's a big one. And you always got to look out for that. When you find that, you've got to ask, what's the nature of that? What's the purchase behavior? Are there contracts in place? Is the product or service the company's selling mission critical, right? Can't be switched. Are there high switching costs? Kind of all that stuff. So that's how you look at and deal with customer concentration. And then, of course, you can mitigate it through deal structure with a forgivable seller note or an earnout, clawbacks to equity, things like that. The second is key person risk. And you see that, virtually in all small businesses, right? The seller is almost always going to be a key person, has relationships, just like we talked about with the CPA, professional services example. But, you really got to look down the org chart to identify other key people. Maybe there's other family members in the business that are doing critical tasks. Maybe there's, a salesperson who holds a lot of the relationships and, you might miss signing a non-compete with that person because they weren't at the top of the org chart and you weren't thinking about that. So looking at key person risk, not only, from the head of the organization, but also down the org chart, that's really important. And again, you can structure in those kind of forgivable dynamics to the acquisition structure through deferred consideration in order to get there and kind of mitigate some of that. So those are the two biggest ones. I'd say the third one that arises every so often is whether or not the value of the business is truly transferable. And this is similar to key person risk, but what we often see is, especially, mainly services businesses that are kind of highly skilled, come up because the individual, the owner is very skilled and, great at that specific trade and has built a brand around themselves and around, their skills in this space. So when you find a business like that,
it's the contractor license coming with that too, right?
There's a contractor license, sure, but you more see this in, for example, high end architecture or design or things like that. It's really hard to transfer that personal brand to a new owner, right? So that's one that's almost like key person risk, exponentially more risky and more challenging to overcome. So I think that's just one worth calling out is the value of the business actually transferable to a new owner?
Gotcha. Have you seen the appetite for SMB investors over the last 12 months? Is it increasing, continually increasing? I had this conversation with somebody earlier today, like, oh, I want to buy before this silver tsunami. Well, I don't really see the law of supply and demand taking effect there. Like some of the levers have to go up and down for this hypothesis to be true. And I don't see that. But
yeah, so interest in investing I think, has grown and is continuing to grow substantially. There has been a lot of conversation about, buy a business. It's a passive income strategy, and I think we all know that at least it's become more and more clear to many folks that that's not really how it works, right? You need to be pretty engaged. But what's emerging out of that is a lot of folks who, started looking at this asset class as more of a passive strategy are starting to say, well, there actually is a way to passively invest in small businesses. And
because they don't want to run it, right? Yeah.
Right. That's by backing someone who does want to run the business. Right. So I think there's growing interest in the passive investing approach because of some of those dynamics. What I will say is, there's been new kind of guidelines around the SBA that, some they counterbalance each other. Some make it more challenging to invest if you, aren't a U.S. citizen or aren't a lawful permanent resident. So that's made dynamics for SBA deals pretty challenging. But then on the flip side, there's guidelines around how deals can be structured. And John, you and I have talked about this, but the kind of, restrictions placed on seller notes and things of that nature may actually drive a greater need for equity, right? And that may drive more capital towards equity investors.
Yeah. So let's take an example. Somebody has a deal under LOI. They're a U.S. citizen. They are cleared for an SBA loan. What's the process of uploading? How long does that take? What kind of questions are you asking of them? You get approved. How do they stand out? I mean, I have a little experience with crowdfunding, the big one in LA, where if you don't take off, they put you on page 5, and you just never fulfill that subscription package. So, what's that look like?
Yeah. So on SMB Investor Network, if someone submits a deal, we look at it pretty quickly and we aim to get feedback within a week or so of people submitting. If we aren't able to kind of underwrite it for Search Fund Ventures and kind of syndicate it to the platform in earnest, we'll still aim to put you in touch with folks that we think it could be a fit for. And there's other lead investors on SMB Investor Network that have different mandates than we do, right? And underwrite things differently. So we certainly will kind of circulate the opportunity to others, and we won't just leave it kind of in the page 5, as you put it, right? Assuming the deal does kind of pass our underwriting criteria, then we would really partner and kind of syndicate that deal to our network. So we would, put Search Fund Venture stamp on it. We do our diligence. We make that available to our investors and make it known that Search Fund Ventures is investing. And, we run outreach to our network to raise for an SPV. So that's really the kind of format and the different ways that we can be supportive.
So what happens after that? And they don't just put it up there and you leave it alone. Is there some kind of action to keep that interest? Like, I know that CrowdStreet up in the Chicago one, they have on their site, sign up for webinars, and
right,
somebody interested in, they can sign up with a webinar, and you give these investor presentations to help them out.
Yeah, that's exactly right. So yeah, we have a whole kind of program around our syndication effort, right? Oftentimes we'll do kind of a Q&A type video. We'll help kind of socialize and I would say distribute all that to our network, not only through the platform, but through our newsletter. And we really do kind of create a holistic, syndication effort around deals that we underwrite. So that is, I would say, a key, component of partnering with SMB Investor Network on a deal.
Yeah. And if I was the business buyer and I put it up on there, I'm not just going to leave it, say, hey, you guys go do your job and I'll go start, going back to my W-2 job. What can I do to push more interest? So should I be active on X and LinkedIn and talking about my deal?
Yeah. So we always recommend that folks, continue to raise the way that kind of they had planned to. And obviously we can help strategize with that. So certainly being, vocal to your network, to other networks, and then of course, participating in calls that we'll bring you in on with interested investors from SMB Investor Network. So That's sort of the communication plan. Like I said, we also put together the Q&A videos, kind of help people get to know you better, and really just, socialize that deal to folks that could be investors.
So normally you have this LOI under 60 days. So you really need more time than possible. So you should be thinking about, as soon as they sign that LOI, the deal package goes up to SMB Investor Network. So you have more time to reach out to these people, because somebody may be on vacation, coming back, whatever it is. You need to cast a wide net, and that takes time.
I think that's right. I mean, the earlier that, you can get a deal in front of us so we can take a look and provide feedback, the, higher the odds of success of your raise are going to be. If you wait till the last, 10 days of your exclusivity period and you haven't been making much momentum and the seller doesn't want to extend, or their broker, their lawyers in their ear saying on to the next, it's going to be really tricky, right?
But I've seen a lot of deals just recently where they do have like 7 days left, and I go, my advice is to go back to the seller and see if you can extend the LOI, right?
Yeah, and from what we've seen, as long as you're making progress and there's positive momentum, that usually that request is pretty amenable. But again, we can make a lot more progress and we can be more supportive the earlier we're in, right? The earlier we kind of
more time you have, the better chances. Increase your chances. So what does that look like to you guys? Are you on the cap table and can take a piece of the action? What does that look like? And I know that Angel List is kind of a standard 2 and 20 deal. Are you same thing?
Yeah. So, we essentially, what happens is we'll end up writing 2 checks for a single deal, right? We'll write a check from Search Fund Ventures, the fund, and then we'll have an SPV, which, our folks from SMB Investor Network, some of Search Fund Ventures LPs may participate in that as well. And then we'll write both of those checks to the, to the actual investment vehicle or to the company, right? The business model, revenue model around it is just a fund model, right? So we have a management fee and a carry both for the fund and for the SPV that we raise.
Yeah. Is there any types of deals right now that investors, I'm assuming you're talking to them then saying, what kind of deals would you invest in? And they say what?
Yeah, I'd say in many cases, people still really like industrials deals, trade contractors, especially ones that are more niche kind of services businesses. There's folks that like kind of more niche manufacturing businesses as well. I'd say, frankly, a lot of what has gotten interest within our network is deals that are priced at a good multiple and have high quality revenue. If you've got those 2 things in place, you've got a really exciting deal for a lot of folks. And generally, I think, part of the reason people have skewed towards these industrial sectors is because, not only do they have that local economies of scale dynamic I mentioned earlier, which makes disruption harder and competition a little bit easier, but, there's a lot of them out there with owners that are ready to retire, meaning you can get them at a decent multiple. And especially if they're doing maintenance type work, that's really high quality revenue.
A need versus a want. Yeah.
So those all, I think it's that trifecta that has caused a lot of folks, rightfully so, to be excited about investing in these industrials type businesses.
Yeah. So what kind of checks do they write on SMB Investor Network? What size?
Yeah. We have pretty low minimums for people to participate. Investors can participate with as little as 10K. We'll bring that into the SPV. And then
I got to ask about that. Let me amend that question. And what rights do they have?
So their rights are with the SPV, right? Okay. So we have a specific LLC, basically, that we'll gather all those allocations into. And then that LLC will invest into the actual business. So there's kind of that, layer between the business and the investors. And we will manage, SMB Investor Network manages that SPV and the relationship with all those investors that would come in.
Gotcha. Very similar to Angel List.
Exactly. Yeah. No, the Angel List model is a really good analog At the end of the day, our goal is to democratize investing in this asset class and support acquisition entrepreneurs and small business. And the best way we see in doing that is very similar to this angel list kind of syndication model.
All right, so I'm going to switch seats a little bit, not be the buyer and asking questions about the investor. Why would I want to be on here and say, yeah, I'd like to take a look at deals. I don't want to run this business. I don't want to run a business. I don't want to manage people. I just want to invest in people. What does that look like?
Yeah, so I mean, you said it right there is the first piece, right? Being able to invest in this asset class as a passive investor is, in our minds, a really big value proposition. It's not easy to find these deals. It's not easy to source good quality deals in this space. So that's one. You can have a look at our diligence and how we're thinking about the deal. You can get that perspective. That's two. A lot of people find that pretty valuable. There's kind of a level of quality there because we vetted it. So that these deals have, roughly 2% of the deals we see make it through the funnel, at least on the kind of search fund ventures co-invest on SMB Investor Network. And, I'd say lastly, that 10K minimum makes it a lot more accessible than, what minimum check sizes generally are in this space, which is closer to, call it 100K or so. So those are kind of the top level reasons that folks invest alongside us.
And if I'm an investor on there and I want to put money, I'm looking at it just like it has all the SEC requirements placed, a private placement memorandum, subscription agreement, everything, the risks involved, right?
That's exactly right. Yep. Yeah. So we have a whole kind of process for making sure that the deals we're supporting from a syndication standpoint are indeed compliant.
Yeah. Lovely. This is why I'm an advisor on this thing, because I really think that there's so many investors on social media and out there going, hey, let's invest in, United States businesses, help them grow, help them transition. So I love it.
Well, that's what we're doing day in and day out. So glad you love working with us, John.
All right. I'm gonna 47. Did I get everything or did I miss something?
Got everything in my mind.
Let me stop that.